Hello and welcome to Starting with the End in Mind, an advisor's guide to preparing business owners for exit planning. My name is Kimberly Deese, and I'm a board certified intermediary with Murphy Business and Financial Services. And in this session, we're going to be talking about what you can do as an advisor to better help your businesses to plan for their exit and have a much more successful exit. Maybe it's in 5 years, 10 years, 15, 20, or maybe even longer. So let's go ahead and get started. As an advisor, your clients come to you looking for your wisdom. They look for your information. They want help with insight on the road ahead. They want you to help them keep their eyes on the long term. And let me show you how to best do that when you're talking about exit planning. And it all starts with, why do people start a business? I mean, think about it. I'm sure if you've been in the industry for a while, whether you're an accountant, an attorney, a financial planner, a business consultant, or a banker, you've seen hundreds, maybe even thousands of people that have started businesses. So why do they start a business? Here are some of the most common reasons that I found. First is for the money. Maybe they got let go from a job and they're replacing that income with a business, and they're buying their own job basically. For others, it's something they love doing. They're smart, they enjoy it, they're good at it. It could be the individual that maybe was a CFO at a company and then they decide to start their own accounting practice. They're widget makers. They're very good at doing things and they like doing it, so they start a business for that reason. The next reason I've seen is that they're fun of it. They want to do something fun. They're looking for more excitement. Whatever they were doing wasn't doing it for them, so they've got a new grand idea. It could be an invention, it could be an idea, it could be a product. It's something that's exciting to them. And of course, there's always the group that do it because they care and they want to help other people. Oftentimes we see this in home health care type ownership. But then, in the end, it comes down to business owners have a passion. They have a passion for something. Their heart's in it. They're excited the day they start that business. But what happens 10, 20, 30 years later? Oftentimes that excitement wanes. They've been doing it. They've got stuck in a rut. The wear of the business the weight of the business has worn them out. So oftentimes they say life happens. Sometimes their health begins to fail. They've been putting in 30, 40, 50, 60, 70, 80 hours a week for sometimes 5, 10, 15, or 20 years. They always thought their kids were going to take over the business, and the kids don't want the business. They see what it's done to the parents, and they don't want to own the business. Sometimes there's partners involved, and the partner leaves, and now we have one person that thought they were going to sell it to the partnership, and that's not available. Sometimes they just want to do something else. They're frustrated. They're burnt out. They've had enough. The employee issues have gotten to them. Their frustrations of dealing with cash flow has gotten to them. They're tired of dealing with clients. They want to just do something else. And then the other reason I've seen is oftentimes the spouse retires, where one person owns a business, the other person's still in a career. They retire and they're frustrated. They want to go travel. They want to go retire. They're ready. But we've got this business. What do we do with it? Well, that's where your role as an advisor starts to come in, because oftentimes when they don't have an exit plan, they exit when they just can't do it anymore. And the sad truth is, that's not often the best time for them to exit. Only 20% of the businesses that we see go on the market for sale actually sell. And that's in the lower middle market. That's businesses under $1 million EBITDA. Typically that's less than 10 million revenue. So the sad truth is, these folks work 10, 15, 20 years of their life investing into a business. They give it their blood, sweat, and tears. They sacrifice everything to be able to have this business, maybe even what they consider a successful business, and in the end, it's really not worth as much as they thought it was. We've come to find out the average business owner retires at 72, and most of the time their business is highly devalued because they never started with a plan to sell the business. They never thought they'd turn 72. When they started the business in their early 40s, early 30s, they just knew that they were going to do something for those reasons we talked about earlier. They were going to make some money. They were good at something. They were going to have some fun. They cared about people. And they never realized they were going to at some point time was going to continue to move forward, and they were going to come to this reality of having to decide what to do with the business. And obviously the majority of a business owner's wealth is usually the value of the business. And so oftentimes many business owners never get what they think their business is worth, and they're frustrated. Some will even say things like, well, I'd just rather shut it down than get paid that little amount. Doesn't make a lot of sense. Employees lose their jobs, customers lose their suppliers. It's a frustrating part for everybody involved. But there's a better way, because here's how most people run a business. They start the business. They work hard. They try to keep as much income as they can. They hide as much as they can from the IRS and everybody else. They are the business. They build it on themselves, their skills, their talents, their networks. The business really is them, their heart and their soul, truly. And the sad part is, because they do everything, it often stays small. They're just too busy to grow it. But there's a better way. The better way is building a business to sell. That means planning to exit the business the day you start the business. Now, I know some of you may be thinking, wow, that's quite early. I mean, who would think to sell a business the day you start the business? I mean, heck, when you're starting a business, you're thinking about payroll, hiring, how to get your suppliers in, how to set your systems up, making sure your computers work. Do you have a merchant service account? I mean, all these things you've got to think about. But here's what: if you can get all that in place and put the exit in place as part of the business plan, you will find you'll build your business different. So when you plan to exit, things that you start to do automatically is you start to build infrastructure. You start to think about, what's the process? How am I going to do this? How am I going to expand? How am I going to get to a $5 million, $10 million, $20 million valuation in 10 years? You focus on the net profit development versus tax evasion. You focus on hiring management and training the staff. You grow larger. And in the end, this business owner ends up having more free time. They have more disposable income. They enjoy their business longer, and the truth be told, they stay in the business longer. Their employees are happier, and they find themselves enjoying the business experience much, much more than if they didn't do it this way. So if we take a look, what is that magical factor? It's that 1 degree variation. It's that 1 degree. And think about if you're a golfer. Now, maybe many of you golf on this training today, but if that golfer just moves his putter 1 degree, where that ball ends up 100, 200, 300 yards out is very, very different than where it would be if he didn't move it that 1 degree. So all I'm suggesting as an advisor is to make that 1 degree variation. Help your clients make that 1 degree, because over the next 5, 10, 15, 20 years, that 1 degree is going to be the difference of whether that ball goes in the hazard, in the pond, or whether they make a hole in one. And you as the advisor have the opportunity to do that for them. They don't even know it exists. And that 1 degree is truly beginning with the end in mind. It's understanding, where are you going to take this business? Where is this business going to go for you? What are you going to do with this business? Now, I'm going to warn you ahead of time. Business owners are going to fight you on this conversation. They don't want to have this conversation. They're too busy thinking about payroll. They're too busy thinking about, how am I going to order? Where am I going to get my customers? What's my marketing? What's my website going to do? Who am I going to hire? They struggle with keeping it all together. But here's what I can share with you. All of those tactics of hiring people, putting together websites, finding customers, mean nothing if you don't have a strategy in place first. So let's talk about what that strategy is. The beginning with the end in mind. Start with the discussion of a 10-year exit plan. And the conversation is pretty straightforward. The way I have the conversation is I ask them, so tell me, you're starting this business, how are you going to get out of the business? And they usually look at me with a blank stare, because they never thought about how they were going to exit the business. They were so excited about starting the business and getting their funding and getting everything in place and finding a lease, they never thought about how they're going to exit it. We've got all these tactics, but we really don't have a strategy to frame those tactics around. So I like to start with a 10-year exit plan, 10-year strategy. So where are we going to be in 10 years? Let's talk about that, because 10 years out is going to determine what your financial projections look like, determines who you hire, even determines which customers you go after. And so we start with a 10-year, and honestly, you could pick any number. You could pick 5 years, you could pick 8 years, you could pick 20 years. I find 10 years is far enough out. Business owners can dream a little bit, but it's close enough that they know it's coming. If I tell them 20 years out, people can't think 20 years out. In fact, the average 20-year-old can barely think 3 years out. So once someone's getting to 30 and 40 years old, if they're at that level, they can usually think out 10 years and say, okay, in 10 years I'm going to be this old. What do you want your business to look like? What do you want your lifestyle to look like? How many hours are you going to spend at home? What are you going to be doing with your family? What type of quality of life do you want? Because depending on what you want depends on how you should build your business. And most people don't think that. They're too busy getting in there and getting started. They don't know where they're going. And a mentor of mine years ago told me, if you don't know where you're going, any road will work. And so let's get them on the path to create long-term success for them. Let's be the advisor that makes a difference. Let's be that 1% changer for our customers. So it starts with understanding, putting it out 10 years, set a valuation. When I did this for myself, I said I'm going to have a $10 million valuation in 10 years. Now, is it realistic? I don't know. But you know what? I've got a target to aim at. Doesn't matter if it's realistic. I'm pushing myself out, and every year I look at that and I say, what do I need to do to get closer to that $10 million valuation? And then I break it down to profits. Well, to get a $10 million valuation, let's say I'm going to get a multiple 2, could be higher, but let's just say 2. That means I have to have at least $5 million of profit. And by the way, 2 is the average multiple of net profit on a small business with under $1 million EBITDA. So my example might be a little bit off, but you get the understanding. So let's say I do a $10 million valuation. My profit then has to be divided by 2, has to be $5 million of profit. In order to get $5 million of profit, I know I run say a 50% margin. That means I have to have $10 million of sales. Okay, now I have a sales goal to work from. So I have $10 million of sales at year 10. So let's say year 5, where do I have to be? Well, let's just say 5 years out, I'm going to say I have to be at a $5 million valuation. Well, let's back it out 2 years out. Well, 2 years out, maybe I need to be at a 1-year valuation, or 1 years of sales, excuse me. So for the next year, I need to work on getting to 1 million in year 2. So my first year, let's say I need to get to a $500,000. So my first year strategy is to get to a $500,000. Then my year 2 is $1 million. And so my question is, my first year, if I'm going to get to a $500,000 of sales, what do I need to do? I'm going to think very different than if all I think is I got to support my family and I need to make $70,000. I'm going to think very differently if I'm building a long-term strategy company than if I'm just worried about paying my bills. And this is why starting with the end in mind is that 1% difference that makes a huge difference over the life of the business. Because remember, these business owners, when they get started, they don't realize in many cases they're going to be running these businesses for 5, 10, 15, 20 years. Now, is that true in all businesses? I can tell you it's not. I can tell you, I don't know the statistics, and you might know them better than I do. A percentage of business owners who start businesses fail. And that's okay. They're going to fail. But this doesn't hurt them in any way, shape, or form. In fact, I believe it helps them because it gives them a bigger target. It gives them more strategy. Their tactics fit into a strategic plan now. So once you've got the first year strategy to get to year 2, now you can repeat this every year looking at your 10-year goal. And at the end of the 10 years, maybe you miss the target, maybe you don't. And maybe you decide, I love my business so much, I can go another 10 years. Perfect. So now you set another 10-year goal and you run another 10 years. But here's the beauty of this plan is what if at year 15 I can't do it anymore? What if at year 15 I'm sick? I'm ill. I can't run my business. My business is prepackaged, pre-ready, and I can sell at any given time for the highest value because I built it to sell it. And that's the key to being a successful advisor to these business owners, is preparing them ahead of time. Remember, we are the advisors that need to look ahead. We know what the road is long before they ever see the road. We know where that road goes. So we prepare them ahead of time so that at any point they say they're ready to sell, perfect. We've already prepared you. You've already done all the things that you need to do in order to get to that next point. So let's talk about 2 examples. Example ABC is a husband and wife lawn landscaping company. The husband plus one other team member goes out and mows. She runs the office. Sales typically are going to be around 250,000 because they can't get any bigger than that. He can't handle more lawns than that, and their profit's probably going to be somewhere around 100,000. They make a decent living for the both of them. They burn out in probably 7 to 10 years because they're putting in sometimes 40, most likely 50, 60, or 70 hours a week. Their valuation ends up being a 2 times multiple of their profit, and they come in at about 200,000. Not bad for 7 to 10 years of worth of work. Business XYZ has been prepared by their advisor. Their accountant told them what was going to happen, and they start building teams. They set up systems. They have management. They have 7 teams and 7 trucks. Sales ends up over $1 million. Now, please understand, their first couple of years, they weren't making more money than ABC Company. In fact, their profit was nominal. But years 6, 7, 8, they were cranking because they had these teams in place. They were building a business. Their profit ends up being about $350,000. They can run the business much, much longer because they're not working crazy hours. They're managing managers. Their valuation comes in over $700,000. Same amount of time, potentially. Same amount of work, but the valuation is more than 3.5 times. So that's the benefit to our businesses. And as accountants, financial planners, bankers, and lenders, and consultants, we are doing our business owners a much greater favor when we prepare them for exit because they have more profit, they have more expendable income, there's more opportunities for us to help them become successful. So in the end, we know XYZ business is the one that sustains and has a higher value. So an advisor's role, it starts with asking early about the exit plan. Don't be afraid to ask them. So tell me about how you plan to exit your business. This is an okay conversation to have. This should not be a taboo conversation. This conversation should be, tell me about where you're going. And then help them create that tenure plan. Help them think through, what's your business going to look like in 10 years? What lifestyle do you want? Review their tenure plan with them annually, and then help provide them resources to grow and mature. Here in the Jacksonville, Florida area, we've got tons of resources, whether it's the SBDC's training program called Scale Up, the Chambers program called Jack's Bridges, or many other programs out there. The business Jacksonville Women's Business Center that has marketing matters, financial matters, Athena program. There's so much opportunity to help them mature because they are not going to be able to do this on the information they know today. They're going to have to grow in their business ownership maturity. So help provide those resources. And then lastly, provide insight on what to expect for the next 10 to 20 years. Most business owners, when they get into a business, they seem to think the economy's always going to be in their favor. The wind's always going to be against their back. We're never going to have a recession. We're never going to have ups and downs. And they don't think about this. So as an advisor, your job is to forecast out. You know, in our economy, every 7 to 10 years we have a recession. It shouldn't be a surprise. Don't let it be a surprise to your business owners. So let's talk about that for the last part of this call. What is the American economy? What can our business owners expect? And how can you help prepare them for those ups and downs? Now, this is information that was shared to me with several economists, and I've done some studying on my own. The information's not my own. Certainly you can Google economic seasons, and you'll be able to find a whole lot more information on this. But our economic cycles go in about a 7 to 10 year cycle. There's a spring, a summer, a fall, and a winter. And so we always want to know which season are we in and what should we be doing in each of these seasons. So the question then becomes, when's the best time to sell? And we're going to go through each of the seasons, and you'll get to see when the best time to sell is, because certainly if you sell in the wintertime, you're going to get a very different valuation on a business than if you were to sell in the summertime or the springtime or the fall time. So let's talk about economic winter. This is the time when you implement your recession plan. This is the time when you hunker down, you start you lighten your load, whether that means you do some layoffs, whether that means you reduce expenses. This is the time to stay calm, continue your marketing, and when your competitors go out of business or are calling you to purchase them, this is the time to take advantage of it. This is the time that in the fall time you gathered your cash so that you could make it through this period. This period usually is only a couple years. The last economic recession was very, very deep and very long. They don't expect our next one to be as deep. The next economic winter we're expecting in 2018, 2019. So we have a little bit of time. But you want to prepare for it. You don't want to be surprised when all of a sudden the faucet turns off. because we know it's coming. This is a great opportunity to be preparing your clients, especially if you're in the accounting world, the financial planning world. Watch their cash. Make sure they're staying cash rich. Make sure they're paying off debt. Help them prepare for this economic winter, and they're going to be thankful for you when it comes. Now, the economic spring. Spring comes unannounced. Winter is when everyone holds their breath and they go, "Oh, something's happening." The newspapers are all talking about this bad economy. The spring is when the newspapers stop talking about the economy, when the sales bottom out. It's a very quiet arrival. Not as dramatic as winter. This is the time when you invest in growth. This is when you make your new purchases. This is when you hire your new people. This is when you take on debt. You wait it out. And I know that's hard because you're going, nothing's changed. It feels like we're still in winter. But in truth, this is when you can get your best deals, because your competitors who are going out of business, there's auctions out there where you can get and buy purchases for 50% of what you'll normally buy in the fall. Now's the time to invest. So in the spring is the time to plant seeds for growth. And so for your business, that means major purchases and hiring. And this summer, this is when you grow your business. You grow into what you bought in the spring. So maybe in the spring you bought a new warehouse, you hired 15 new people. This is when you ramp up all your marketing. You start saving again, you raise prices, you expand. This is the time to take on debt, is your summer. And your summer just flows right into your spring. You kind of know, because people start buying again, sales start coming back, you can start growing into what you've had. And of course, after summer, our crops mature and we go into a fall, and that's our time to sell again. So that's the time when we start having lots of sales. So you kind of see the cycles and you get an idea of how to handle that. The economic fall is just like the seasonal fall. It's a harvest time. It's when you sell what you have. This is the time of year that you've spent all summer toiling on the fields. You've been growing the harvest. You planted the harvest in spring, you tended to the harvest in summer, and now wintertime is the time to sell, or excuse me, fall is the time to sell. And in the fall time is oftentimes when we see people like drunken sailors. They buy things up. Cash is flowing freely. People are buying because they feel great. The economy is in its heyday. People have kind of exhaled and gone, okay, everything's good again. Life is good. We're back to normal. And this is the best time to sell, because this is when the hopes and the optimism of the economy is at its highest. Is when people are willing to pay the most, they have the least fear, banks are lending the most. This is the time that you want to gather cash, and you want to make sure that you're spending that time in pulling as much sales as you can. If you've got a business you're ready to sell, you want to sell now. Currently, 2016, we are in an economic fall. So this is a great time if you have a business owner thinking about selling. We've got buyers, banks are lending. It's just a great time of year to be doing that. Now, looking at starting with the end in mind, really today's presentation was really about three things. It was about creating an exit plan, a 10-year exit plan. Of course, you can choose any year that works good for you or your clients. I just find 10 years seems to be a good number. And you want to make sure that you're working on that the day they start their business. So it doesn't matter whether you're an accountant, attorney, a financial planner, a banker, or a business consultant. This is your opportunity to add value to that relationship. Show them that you truly care about your relationship. Show them your expertise, your knowledge, and give them a reason to stay with you. Then review that exit plan annually and make those adjustments. Have them make the adjustments. You're just holding them accountable. All you're doing is being a good advisor here. And then lastly, know what season it is and help them manage the business for maximum success in each season. By knowing your seasons and by knowing how the economy flows, you can help them to make better decisions and help them to manage for their success, because it does them no good if they do a huge amount of debt in the fall and they end up out of business in winter. You want to make sure to help them through that process. So my name's Kimberly Deese. I'm a board-certified intermediary with Murphy Business and Financial Services. I'm located in Jacksonville, Florida. If you have any questions about this, please don't hesitate to visit my website, Sell Your Business Florida. I have tons of content on our blog. You can certainly give me a phone call. I'm always happy to work with advisors and help you to better prepare your businesses. If you ever have any questions about exiting, selling, anything that involves a business sale to a third party, be more than happy to take your question, complimentary, and be a resource for you. I hope you have a great day, and I wish you all the best.